Thank you for tuning in, Dividend Dashboard here, and welcome to the October Portfolio Update. These are the videos that I do on a monthly basis for those who follow me in this journey to financial freedom. In this type of videos, I usually cover the stocks I bought for the month, dividends received, dividends year over year, portfolio value, performance, and much more. If this is your first time watching my content and you like to follow my investing journey, consider subscribing or liking this video. My goal is to keep growing this channel and connect with other investors on a similar path so we can learn, build, and grow together. So with no more additional fluff, let's dive in. I bought 5 companies for the month of October, starting with Automatic Data Processing, adding 0.22 shares. It's one of my most reliable holdings when it comes to steady dividend growth and consistency. The long-term compounding and business quality make it a cornerstone in my portfolio. Next, I picked up 0.94 shares of S&P Global. This company continues to impress me with its pricing power and essential role in the financial ecosystem. It's one of those names I plan to keep building over time. High quality, white moat, and strong dividend growth potential. I also added 0.65 shares of Texas Instrument. The stock has been trading in a more attractive range lately, and I want to take advantage of that. Texas Instrument combination of a solid yield, reliable cash flow, and shareholder-friendly management makes it one of my favorite tech dividend plays. For the consumer defensive side, I grabbed 1.22 shares of Kroger. It's not a flashy stock, but it adds great stability and dependable dividend to the portfolio, with consistent cash flow and a strong presence in the grocery space. I like it as a defensive anchor during uncertain times. Lastly, I pick up a full share of Nike. The stock has faced some challenges recently, but I see this as an opportunity to accumulate a strong brand at a better valuation. Nike still has global reach, strong margins, and long-term growth potential, all while returning capital to shareholders. For the month of October, 4 companies pay me a dividends. JP Chase, $8.93, Automatic Data Processing, $6.41, Nike, $5.11, and Realty Income, $5.91. In total, October brought in a combined $26.36 in dividends. October is one of my lowest months in terms of received dividends amount. This is due to the companies that paid this month and that I am not heavily increasing their allocation. Regardless of that, each month payment represents progress toward financial freedom and that long-term goal. When I look back at how far my dividends have come, it's incredible to see the steady progress year after year. Each October, the numbers might not be the biggest, but they always remind me how consistency compounds over time. Even though this is one of my lowest paying months, the growth trend speaks for itself. Every year, the total keeps climbing, a reflection of regular investing, reinvesting dividends, and sticking to quality companies. It's a great reminder that dividend investing isn't about short-term results. It's about slow, consistent progress that builds momentum over the years. Each payout, no matter how small, is proof that the plan is working and the compounding is doing its job behind the scenes. Moving to my portfolio update, it's currently sitting at almost $31,000 with a projected annual dividend of $600.66, but year to date I have received $454 in dividends. The portfolio sits with a 2.26% weighted dividend yield and consists of 21 holdings. Performance-wise, so far this year my portfolio has gained solid ground, delivering positive return and steady growth. While it's currently trading the S&P 500 performance, I'm not too focused on short-term comparisons. My strategy is built around long-term compounding and dividend growth, not trying to beat the market every single year. The key for me is owning high-quality businesses that consistently generate cash flow, increase dividends, and strengthen their fundamentals over time. As those dividends grow and get reinvested, the gap tends to close naturally. I rather underperform in a hot market while holding strong companies that chase short-term returns that don't last. My portfolio is built around quality and long-term durability. It's made up of businesses with strong balance sheet, consistent cash flow, and proven history of rewarding shareholders through dividends and steady growth. Going clockwise, we have Apple, Colgate, Realty Income, Procter & Gamble, Waste Management, Kroger, Starbucks, JP Chase, Home Depot, Johnson & Johnson, Nike, AbbVie, Texas Instrument, Hershey's, Pepsi, Visa, Automatic Data Processing, MasterCard, Google, Microsoft, and S&P Global. The foundation leads towards companies that dominate their industries, global leaders with wide moats, reliable earnings, and the ability to keep growing even through market cycles. I focus on businesses that don't just pay a dividend, but have the financial strength to raise them year after year. There's a healthy balance between growth and stability. A portion of the portfolio is tilted toward innovative, high-margin companies driving the digital economy, while another part is anchored by steady dividend payers in consumer staples and essential services services. This mix helps capture growth potential without sacrificing income reliability. I also keep exposure across sectors, from technology and finance to healthcare, consumer defensive, and industrials, which provides diversification and helps smooth out volatility. The overall goal is simple: build a portfolio of exceptional companies that can compound wealth and income over decades, regardless of what the market does in the short term. Looking at my annual dividend breakdown, it's clear that my portfolio has started to mature into a wealth-balanced income machine. Some positions contribute steady, reliable cash flow month after month, while others are smaller but growing quickly as I continue to add shares over time. The key for me is maintaining balance. I'm not chasing yield, but I also value having enough income-producing stocks that keep the compounding engine running. Each position, big or small, plays a role building dependable cash flow that keeps growing year after year. Every dividend received is a small reminder that progress is happening quietly in the background. It's not about the size of each payout. It's about the direction they're heading, and seeing that steady upward trend reinforcement why I stay consistent with my strategy and keep building towards long-term financial freedom. Moving on, this is a new chart that I added to the portfolio updates. A frequent viewer commented in one of my videos that my profits in my positions were unclear. So the main purpose of adding this chart is for transparency and better understanding of the numbers. This is the best chart I could use to display the numbers, so it might be a little confusing when reading them. So let's go part by part. In blue, we have the invested capital. This is the money I have invested in the position. In white, that will be either the profit if the white bar is to the right, or loss if it's to the left. Unfortunately, the graph doesn't show certain numbers if the area where it's displayed is too small. I tried tweaking it, but no luck. But overall, you can see most of the numbers. Since this is a newly added chart, I will need feedback from you, the viewer. What do you think about this chart? Do you want me to keep using it in future videos or not? Please let me know in the comment section below. Now, looking at the total return across the portfolio, I can see a clear mix of outcomes. Some positions are performing exceptionally well, others are holding steady, and a few are still in the red. And honestly, that's exactly what I expect from a long-term diversified strategy. Some of my core holdings have been driving most of the gains, showing how powerful compounding can be when you stay invested in quality companies over time. On the other hand, a few positions are lagging behind, mainly due to the short-term headwinds or sector rotation, but I am not too worried about the temporary dips. Those often turn into great buying opportunities. The key for me is staying focused on fundamentals rather than short-term performance. Dividends are still growing, income is still compounding, and the portfolio continues to get stronger each month. The total return will always fluctuate, but my long-term conviction in high-quality businesses doesn't change. In the end, it's not about chasing the biggest winners, it's about building a portfolio that can consistently grow and pay me for decades to come. That will be it for this portfolio update. If you made it to this part, thank you so much for supporting me. Don't forget to like and subscribe for more. Thanks for watching, and I'll see you in the next one.